FAR.F3.M1.
Cash sounds like one of those topics that should take about 5 minutes. Cash is cash. Next module.
That's exactly why people get tripped up. The FAR exam loves topics that look obvious until they ask one small twist. Is this actually cash? Is it a cash equivalent? Is it restricted? Does it even belong in the cash balance? Then they hand you a bank reconciliation, and suddenly, everyone's confidence disappears.
So, this episode is really about learning to think like the balance sheet instead of thinking like a checking account.
Exactly. There are really two major ideas. First, deciding what belongs in cash. Second, explaining why the bank says one number while the company's books say another. If you understand those two ideas, most of this module becomes surprisingly logical.
Let's start with the first one. When someone says cash, I picture dollar bills, coins, maybe money sitting in a bank account.
That's a good starting point. The textbook defines cash as currency plus demand deposits at banks and similar financial institutions. It also includes deposits you can readily withdraw at any time.
So, checking accounts definitely qualify.
Right. Savings accounts qualify too, even petty cash qualifies, because it's still immediately available cash.
Now, here's where accountants immediately make everything more interesting. Cash equivalents.
And there's one rule you absolutely cannot forget.
The famous 90-day rule.
More specifically, the original maturity must be 90 days or less when the investment is acquired. That's the part students often miss.
I like thinking of this like grocery shopping. Suppose I buy milk that's already going to expire tomorrow. That's very different from buying fresh milk today and waiting until it's only 1 day from expiration.
That's actually a great analogy. The investment has to be born short. You don't get to wait until a 1-year investment only has 90 days left and suddenly call it a cash equivalent.
The clock starts when you buy it, not when you're preparing financial statements.
Exactly. The textbook specifically emphasizes that original maturity matters at the purchase date.
So, treasury bills with original maturities of 90 days or less.
Cash equivalents.
Commercial paper.
If it meets the original maturity requirement, yes.
Certificates of deposit.
Again, only if the original maturity is 90 days or less.
The exam writers love that phrase, original maturity.
Because if they simply asked, does this investment mature in 60 days? Half the class would answer yes without asking when it was purchased.
Here's another mental shortcut. Cash equivalents aren't about making more money. They're about parking cash somewhere so safely and so briefly that economically it's almost the same as holding cash.
That's a really useful way to think about it. These investments are highly liquid and carry insignificant risk of changes in value.
Now, let's make life difficult. Restricted cash.
Restricted cash is still cash. It just isn't freely available.
So imagine you own a savings account, but your parents tell you that money can only be used to buy a car. Technically, it's your money. Practically, you can't spend it on pizza.
Exactly. Restrictions limit how the cash can be used. The important accounting question becomes, what is the restriction related to?
Because that determines whether it's classified as current or non-current.
Right. If the restriction relates to a current asset or current liability, it's generally classified as current. If it relates to something long-term, like acquiring property or equipment, it's generally classified as non-current.
So the restriction changes the presentation, not the fact that it's still cash.
Exactly. Don't accidentally remove it from cash entirely.
Now we get to the part everyone either loves or fears. Bank reconciliations.
Mostly fears.
Mostly because people memorize pluses and minuses instead of understanding what's happening. Here's my favorite analogy. Imagine 2 friends are keeping separate journals about the exact same road trip. One writes everything immediately. The other waits until the hotel each night. Their stories won't match during the day. Eventually they should.
That's exactly what a bank reconciliation is. The company keeps one record. The bank keeps another. Both are tracking the same cash. Timing differences and recording differences create temporary disagreements.
So, reconciliation isn't asking which one is correct. It's explaining why they don't currently agree.
Exactly. That's probably the biggest conceptual takeaway in this module.
Now, let's introduce the question that solves almost every reconciliation problem. Who already knows?
I love that question. Every reconciliation item becomes easier if you ask whether the bank already recorded something or whether only the company's books have recorded it.
Let's start with deposits in transit. The company already recorded the deposit. The bank hasn't seen it yet.
Perfect. So when reconciling the bank balance, you add deposits in transit. Because the bank balance is temporarily missing money, it will eventually recognize.
Outstanding checks are the mirror image. The company already recorded the payment. The bank hasn't processed the check yet.
Exactly. That means the bank balance is temporarily too high because those checks haven't cleared. So outstanding checks reduce the bank side.
Notice something interesting. Neither of those requires a journal entry.
That's huge. The company's books were already correct. The bank simply hasn't caught up.
So here's another shortcut. Timing differences usually stay on the bank side. Recording corrections usually affect the books.
That's not a perfect rule, but it's an excellent starting point.
Now, let's talk about NSF checks. These scare people because the abbreviation sounds mysterious.
NSF simply means non-sufficient funds. Your customer gave you a check. You deposited it. The bank later discovered the customer's account didn't actually have enough money.
So the bank removes the money. The company has to remove it too.
Exactly. Since the company originally thought it had collected the cash, its books now need correcting. That means a journal entry is required.
Same story with bank service charges. The bank knows immediately. The company often finds out only after receiving the bank statement.
So those charges reduce the book balance during reconciliation because the company's records need updating.
Interest earned works the opposite direction. The bank credits interest. The company hasn't recorded it yet.
Which means the books need to increase cash. Again, journal entry.
So here's another memory trick. If the bank surprises the company with new information, the books usually need an adjustment.
Exactly. Think of the bank statement as delivering news. Sometimes it's good news, interest income. Sometimes it's bad news, service charges, or NSF checks. Either way, the books need updating.
Errors are a little different.
Because now you have to determine who made the mistake. If the bank made the error, the correction stays on the bank side. If the company made the error, the books need correcting.
Again, we're asking exactly one question. Who needs to catch up?
You've probably noticed that this entire chapter keeps coming back to that idea.
Now the textbook also introduces something that sounds intimidating. Proof of cash. 4-column reconciliation.
It sounds much worse than it actually is. Instead of reconciling just one ending balance, you're reconciling beginning balances, receipts, disbursements, and ending balances together.
Almost like balancing an entire month's story instead of checking only the last page.
Exactly. It provides more information because it reconciles both inflows and outflows of cash. It's especially useful when trying to identify where differences occurred during a period.
The calculations can become long. But, conceptually, nothing changes. You're still comparing what the bank knows with what the company knows.
That's why we aren't spending 20 minutes doing arithmetic. The FAR exam rewards understanding the relationships more than memorizing mechanical steps.
Let's hit some favorite exam traps. Ready?
Go for it.
Trap number 1. An investment has 60 days remaining until maturity. Cash equivalent.
Only if its original maturity was 90 days or less when acquired. Otherwise, no.
Trap number 2. Restricted cash disappears from the balance sheet.
False. It's still cash. The issue is presentation and classification.
Trap number 3. Outstanding checks require journal entries.
No. The books already recorded them. They're timing differences.
Trap number 4. NSF checks affect only the bank.
Also false. The company's books must reverse the collection because the cash wasn't actually received.
One thing I appreciate about this chapter is that it teaches a habit you'll use everywhere in accounting. Don't memorize lists. Understand information flow.
That's such a good point. Accounting is often about asking who has recognized an event and who hasn't. That idea comes back in receivables, inventory, revenue recognition, leases, and so many other topics.
Before we wrap up, let's build one final mental map. Imagine a giant funnel. At the top is every financial asset a company owns.
Only some of those qualify as cash.
Then, an even smaller group qualifies as cash equivalents because they're extremely liquid and satisfy the original maturity rule.
Some cash may also be restricted. Still cash, just not freely available.
Then once we've decided what belongs in cash, the next question becomes whether the company's cash records agree with the bank's records.
If they don't, we don't panic. We simply ask why. Timing difference? Recording difference? Bank error? Book error? Who already knows about the transaction?
If you keep asking that question, reconciliation stops feeling like random arithmetic and starts feeling like detective work.
And that's exactly how the FAR exam wants you to approach it. Understand the story first. The calculations become much easier because every adjustment has a reason.
So, if you leave this episode remembering only 3 things, make them these. Original maturity determines cash equivalence. Restricted cash is still cash. And every bank reconciliation starts by asking who already recorded the transaction.
Master those ideas, and you've built the foundation not only for this module, but for many accounting topics that follow.